what we're seeing on that one. Tushar Pradhan, director at HXGON Partners, joins us on the show. Hi Tushar, good afternoon and good to see you in. How are you feeling about the markets? At the start of this week, there was that scare that everyone got is, people are talking about we have seen this before and this is the start of something. Till now, at least it hasn't played out. What's your guess from here on? We go through a bit of a time-wise correction, or do you believe we could be bracing for a sharp price-wise correction as well?
Yeah, so many questions in that one question. So I'll try and attempt, coming to some view on what I have looked at in the past and how things are looking right now. I think 2-3 things need to be clarified. You have to understand that the India market currently is going on a lot of liquidity, and which is domestic liquidity. While the international liquidity does cause a lot of volatility in between, you have to understand that this domestic flow continues to hold the market up no matter what. Now, what we actually saw last week, or even just this week as we speak, is due to the fact that the interest rates in Japan caused a flutter in the carry trade. And the bigger impact we saw in the US markets, where a lot of this carry trade was actually executed. India, being a very small part of the overall carry trade as a percentage in any case, should not have been affected. But the sentiment is what got us as well. And that's what happens to markets. Now, if you look at the unwind which has happened in the US post the interest rate increase in Japan, that is more or less over. I think 2/3 of the carry trade has already been reversed and the losses taken. And as we've seen in the last couple of days, the US markets have rallied very smartly. As a result, I think the India correction or whatever it was generally just a response to what was happening globally. There wasn't anything locally to suggest that there is a very sharp correction due. The credit policy came and went. There was no change in terms of the view. There was some hint of a hawkish nature to the statements. But I think that was very rational, because if you're talking about 7.3% GDP growth, then there is no reason for you to cut rates at this time. And on top of that, if you are having an issue in terms of collecting deposits as it is in the banking system, then interest rates cuts are not going to do any of that for you in any case. So I think the case being done, the event having passed by, I still don't think that there is any reason significantly to expect a correction just because we think the markets have run up. I think that's the view that I have right now.
All right, so you're not expecting a correction just because the markets have run up. We'll speak about valuations in just a bit, Tushar. Meanwhile, while we were talking, we also had the numbers of Berger Paints flash by at the bottom of your screen. Looked not particularly bad. In fact, there was a 2% revenue growth that compares with other players. Asian Paints had a 2% revenue decline. Kansai Nerolac had a 1% revenue decline as well. So in that, a positive growth is something that the street likes. Yes, the EBITDA did decline. But remember, at the same time, last quarter was the best ever EBITDA margin that the company had recorded. So they had an element of high base. Thereafter, there was some price cuts that the company took and also increased their spends on advertising. Ever since then, the industry has announced price hikes to the tune of 2 to 3%, so that should hold margins going forward. The most important internal this time around has been, while the volume growth has been double digit, the market share that the company has seen in terms of an improvement is the highest that they've ever seen in this quarter itself. So that should assuage some concerns of market share loss for number 2, number 3, number 4 players in the event of a big competition coming in from the likes of Birlas as well as JSW. So Asian Berger Paints, as a result of which, currently has moved higher despite a decline in the EBITDA and profits. A 2% revenue growth is better than the industry, and they've gained market share the most that they have in this quarter itself. Tushar, your thoughts on some of these consumer names? While we've seen them rally over the last month or so, from a year-to-date perspective or for the last 2 years, they haven't seen much in terms of a move. There's been more of a time correction, valuation correction as well. Do you like any of these staples ahead of expected recovery in rural consumption?
So I think the question is, again, I would break it up in 2 parts. Do I like those companies? I absolutely love them. Simply for the fact that you have an economy like India, where it is just starting to, reach this kind of distribution for consumption of, these goods and services at a level at which, it's going to explode from here on. So do I like the longer term prospects of these companies being in the business? Absolutely, yes. But as you mentioned, in the last 2 years, most of these companies have been trading on an average between 50, 60, 70 times. Take a pick. Uh, in anticipation of this continued growth that we will see. So on one side, you have to understand that the growth will continue no matter what we do about it. Sentiment will drive what would you like to pay for them. And typically, a good company may not make you money in the stock markets. While the reverse may not absolutely be true, sometimes it is true. It is all about the valuation that you think is attractive given the potential, rather than it being a good company, rather than it being in a good sector, rather than it being a sector which is favored because of tremendous order flow, rather than being in a sector which is absolutely solid in terms of how the execution will come in the next 2, 3, 4 years. The key question is, what price do you buy them? So I think these are two different parts of the question I will answer. So I think one of the observations your question itself had was that, is there a time correction that we've seen? So yes, clearly. So in spite of pretty significant margin improvement on the back of some price increases, these companies have taken slightly better environment in terms of rural demand, which we should expect to start kicking in some time from now, and the overall demographic situation not having changed. So in the long term, I don't think you're going to miss something along the way. But what is the cost of waiting? The opportunity cost of being in good companies, quote unquote, and then waiting for them to kind of kick in because their overvaluation will then correct over a certain period of time by time value is a difficult prospect to keep. So I would think that as a portfolio allocator, and if you're building a portfolio, I think you should definitely keep some defensive. And then these are the stocks which start doing well the minute there is crisis in the markets elsewhere, as we've seen. So it's a good, soft kind of defensive play to keep in a portfolio. But to keep thinking that, is that going to be the driver for my return in the next few years? I think the valuations are telling you another story. So that would be my take.
Do you want to tell us in terms of sectoral allocation in your portfolio? What would you recommend now? What is it that you're comfortable buying?
So I've been saying for some time that manufacturing and industrials are areas which are of a lot of interest to me. But again, here the spectrum of valuation is pretty wide. So when you look at the typical MNC industrials, they are again in your 70s, 80s stratospheric Ps. If you look at even middle-level engineering companies, manufacturing domestic, they're still fairly expensive compared to their longer-term averages. So nothing really jumps up at you. But there is a fairly largest number of companies, which I would call mid-caps, which actually are in a supply chain going into the OEMs, or I would call the larger industrial companies. And I think that is where the opportunity continues to be, because it is a little bit like the auto story. So you can have the OEMs, which will have a certain rate of increase, but the auto ancillary companies will actually have a greater party, if you wish, if you can identify one or two which have not caught the valuation bug, and you can play that like there. So I think infrastructure, manufacturing, industrials would be very much part of my favorite list as of now. But again, within infrastructure, I think there is an entire supply chain, and I've been through that cycle once to know that there are companies which supply the infrastructural companies, there are infrastructure companies, and there are infrastructure financing companies. So I think one can take a choice across there. The growth is pretty solid for the next 2 or 3 years there. I think across the spectrum, you will get some opportunities both in the services area. So I think technology is something that we should keep looking at. And not because of what happens to the US economy per se, but I think within there are some select plays which bring out some nuance of the technology play overall. So I think that might be something to look at. But again, valuations don't support you largely on an average there. So again, we'll be fairly circumspect there as well. I think the chemicals, specialty chemicals, and the pharma space, I think again gives us a fair bit of opportunity to look at. Within that, I would still look at chemicals and specialty chemicals a lot more closely. I think the overall trends where the crude oil prices are largely more less in control. We are not expecting a huge global economic uplift to bring oil prices up. So you have raw material prices which will remain low. And then the demand for specialty chemicals and derivatives will continue to be very strong, especially for India, including the China Plus story, China Plus One. And I think that is where some of the attractiveness will continue to be. So I hope I've given you a fair idea of what kind of sectors we like right now.
Good speaking to you as always, Tushar. Appreciate you joining in and giving us your reading of the markets. Wishing you a good weekend ahead. We look forward to having a chat with you in the coming weeks.